So every year, Warren Buffett will write a letter to his shareholders. So in these letters, we can take a peek into Warren Buffett's mind when he makes investment decisions. Over the years, the letters have gotten more and more high level as Warren Buffett will be discussing his investment philosophy rather than the nitty-gritty details of investing. So in today's video, I would like to take a deep dive on Warren Buffett's letter to shareholders 2022. And yes, all the letters are archived in Berkshire Hathaway's website, link in the description below. So let's get started.
So right off the bat, Buffett is showing us his report card, Berkshire's performance against the S&P 500 over a 58-year period. So we can see that Berkshire gained a whopping 3,787,000% versus the S&P 500's 24,000%. If you have invested in Berkshire over this 58-year period, you would have made 153 times more than putting your money in the S&P 500. So all we need to do is to put our money in Berkshire and let Warren Buffett do his magic, right? Well, actually, the answer is actually a little bit more complex than that. So the bulk of Berkshire's returns were made between 1965 and 2000. However, if you're an everyday investor like me, you may not have the ability to put your money in Berkshire or S&P over a 58-year period. Instead, you may wish to withdraw your money after, say, 5 years, 10 years, or 15 years. So how are the returns for Berkshire versus S&P over these periods of time? Over here, we can see that over a 5 and 10-year period, it actually paints a very different picture because S&P actually won Berkshire over this period of time. And over a 15-year period, S&P and Berkshire are virtually the same. It's only at a 20-year period where Berkshire managed to significantly beat the S&P 500. This huge discrepancy that we see is probably in part due to the sheer size of Berkshire. As Berkshire gets bigger and bigger, it becomes more and more difficult to grow the company at the fast pace in which it once did, and it is also probably in part due to the low interest environment that we find ourselves in. Buffett himself has admitted that he has trouble finding good investment opportunities in a low interest rate environment. In the next segment, Buffett is telling us about the advantage of buying a publicly traded company versus a controlled business. One advantage of publicly traded segment is that episodically, it becomes easy to buy pieces of wonderful businesses at wonderful prices. It is crucial to understand that stocks often trade at truly foolish prices, both high and low. Efficient market exists only in textbooks. Buffett is saying that stocks will often trade both above and below their intrinsic value, and it is the job of the investor to find such moments and take advantage of it. We want to pay just 50 cents for something that is worth $1, and in the investing world, one of the most popular ways in which analysts try to evaluate company is through something known as the discounted cash flow model, and here's a clip on Buffett talking about it.
Well, intrinsic value is what is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about.
Don't be disheartened if you're unable to find something to buy for below its intrinsic value right now, because according to Buffett, good bargains don't come by very often, and in his case, only once every 5 years. Having said that, let's now take a peek behind the curtain as to two of Buffett's great decisions. So the first success story is Coke, which Warren Buffett holds till this very day and represents his fourth largest holding. Buffett finished buying 400 million shares of Coca-Cola in 1994, and this costed him $1.3 billion, then a very meaningful sum to Berkshire. Today, the Coke investment is valued at $25 billion, a whopping 20x. And more importantly, the dividend paid from the Coke investment is worth $704 million today, and this represents more than 50% of the original investment. Similarly, the American Express investment costed Buffett $1.3 billion in 1995, and today this investment is worth $22 billion, and he is receiving a $302 million dividend from this investment. So I guess the lesson here is that the REITs wither away in significance as the flower blooms. Over time, it just takes a very few winners to work wonders. You don't need a lot of companies, you just need a few good companies to have a very good investment career. So to further drive home this point, let's take a look at Coca-Cola and American Express. You could have bought Coca-Cola and American Express in 2004 and 2005, 10 years, that's right, 10 years after Buffett bought shares, and still make 2 times your money. And this is pretty much in line with what the S&P 500 did since 2005. Before you rush off to buy dividend stocks like Coca-Cola or American Express, a word of caution from me if you're not a US tax resident, because you might be subjected to a 30% dividend withholding tax. Take a look at this. This is the breakdown of dividend withholding tax by countries. So if you are from countries like Australia, Belgium, Austria, Canada, or even China, you'll be subjected to a lower dividend withholding tax compared to other countries because your country has entered into a tax treaty with the US. However, if you are like me, I'm not from any of these countries and I'm subjected to a 30% dividend withholding tax. I would be very cautious about relying on these dividends from companies like Coca-Cola or American Express as a very stable source of income. I know that this list is not exhaustive, so I've included a link in the description below for you guys to check. So in this next part of Warren Buffett's letter to shareholders are actually nuggets of wisdom by Charlie Munger, Warren Buffett's right-hand man and Berkshire's vice chairman. He started by saying that the world is full of foolish gamblers and they will not do as well as the patient investor. Patience can be learned. Having a long attention span and the ability to concentrate on one thing for a long time is a huge advantage. So to start off, here's a clip of Buffett talking about the gambling activity that's going on in the stock market.
But desire of people to gamble, and they gamble in stocks incidentally too. Day trading, I would say, very often came very close to gambling as defined. But people like to gamble.
So the next piece of advice that Warren Buffett gave is, day to day, the stock market is a voting machine. In the long term, it's a weighing machine. In the short term, the price of a stock are decided by the news headlines and the popularity of a stock. But in the long term, stocks are determined by the value of the underlying business, and you should place more focus on the value of the underlying business as investors. So you should ask yourself questions like, how much cash is the business generating and does the business have a moat? Warren Buffett then cautions us against the use of leverage because there is nothing as 100% when it comes to investing. Always don't overextend ourselves and remember to be safe. So the last lesson from Warren Buffett is that you have to keep learning if you want to become a great investor. When the world changes, you must change. So he actually provided an example on railway stocks. I don't really have deep insight on the American railway system, but the example he provided here is BNSF, a company that Berkshire acquired in 2010. So a little bit of context is that the railway industry back in the 1900s had over 130 railway companies, and fast forward to 2010, there were only 7 companies left. And the company that Warren Buffett acquired, BNSF, was one of them, and they mainly operate on the rail lines west of the Mississippi River. So I guess the lesson here is that as investors, when something fundamental change about the business, you must re-evaluate your previous thesis and make a new decision. So with that, we have come to the end of this video, and from this letter to shareholders, Warren Buffett has been saying one thing, and that is to become a patient investor, and you don't need a lot of stocks to be a successful investor. You just need a few. Thank you for staying all the way to the end of the video, and I hope to see you in the next one. Bye bye.